This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
I'm doing great. I said we're matching. We're all black today.
That's right. I got to wear black on Mondays. We got to match. It's all fun. Hey, so one thing I thought we would do is have a brand new discussion topic that no one has ever hit on my channel before, because frankly, no one does it like you do, and that is really a look inside the fixed income market. So let's define what that is for the mom and pop out there, and then talk about it being the canary in the coal mine, because it's kind of screaming right now. So let's talk about it.
It is, yeah. So fixed income, for lack of a better way of putting it, just think of bonds, right? So corporations like Apple can issue bonds. The U.S. government is a massive issuer of fixed income or bonds in the way of treasuries. You can look at anything from low grade companies, which are referred to as high yield. Sometimes they're called junk bonds. And then investment grade is the higher quality companies that are issuing debt. And then there's also there's also emerging market debt from overseas. The global debt market is actually a much bigger market than the global stock market is, which surprises a lot of people.
By what, like, isn't it like a factor of 10? I mean, it's like way bigger.
Yeah, I don't have the numbers in front of me right now, but it is significantly bigger. I think it's about 3 times is
okay.
Take that as off the cuff, but I think that's about the difference there. And people talk about markets all the time. And when they talk about markets, it's almost exclusively about the stock market. It's like, hold on, the bond market's actually a significantly bigger piece of the investment universe than the bond market, or than the stock market is in general. And
yeah,
to your point, it's been an interesting kind of look at what the heck is going on with this economy, because the bond market is usually referred to as the smart money, if you will. And that's just the way that history has kind of deemed it. What you normally see is that the stock market trails the bond market. So in good times and in bad times, the bond market generally tells you better times are coming when it's tough, before the stock market does. And in the case that we're in now, worse times are coming ahead of when the stock market is telling it as well. And it's pretty uncanny, but you've started to see that canary start to squawk a little bit. So I can talk about that, but what do I need to clarify before we kind of get into that conversation a little bit?
Again, the debt market, bond market, whatever you want to call it, fixed income is bigger. It is what is historically been called the smart money. It's also, in my opinion, it is the market that is most directly impacted when the Fed takes it to zero. And again, the Fed came in as the largest buyer, and they even started buying corporate debt right at the beginning of
this time ever.
Ever. And to see the reversal of what's going on, and to see, I mean, the fixed income market, correct me if I'm wrong, has seen some crazy losses in the last 100 to 120 days. So let's talk about that. And then what's it really squawking about now?
Yeah. So it's been a bloodbath, an outright bloodbath in fixed income. So if you look at the last 20 years, the worst year ever for the Barclays aggregate. So the Barclays aggregate, think of it as the S&P 500 for all intents and purposes of the bond market. So the worst year in the last 20 years, the Barclays ag was down 2%. Okay. 2. Single digits, barely negative,
that many,
right?
1, 2.
Yeah, yeah, exactly. And at one point this year, although it's rallied just a little bit since then, it was down over 11%. So that's 5.5 time multiple.
Yeah,
that's more than 1 digit. Exactly right. And I think the stat is, and you might not want to quote me on this, but I'm pretty sure this is the case. If you were to stop the year right at that point when it was down 11.5%, and it's rallied marginally since then, that would be the worst year in like the last 200 years, something like that. So it's really been a bloodbath in fixed income. And to your point, they're the ones most directly affected by the Fed. And so the easiest way to discuss what the bond market is telling us is by looking at the Treasury yield curve. So the Treasury yield curve, if I was lending you, Michael, money, if it was a short period of time, I might require you to pay me, if I lent you $10, an extra dollar. Fair. It's a short period of time. I kind of trust you. I'll lend it to you for a week. You give me back 11.
Yep.
If you go out and all of a sudden I'm lending you money for 10 years, you better give me that $10 back plus $4, because that's a long period of time for me to be forking over cash before I get it back.
Yeah.
And that's how the Treasury market's supposed to work as well. So when you look at the T-bill, which is very short, and then the 2-year Treasury bond, and then you can go all the way out to the 30-year Treasury bond. The 2-year Treasury bond you should have to get significantly less interest from the government to lend them money for that period of time, because 2 years is a very short period of time relative to 30 years.
Correct.
So 30 years, if you're lending them for that period of time, you would expect a significantly higher degree of yield associated with that bond.
Mm-hmm.
Right now, the difference between those two, the 2-year and the 30-year, is 11 basis points,
That's amazing.
0.11%, which is crazy. So I'll give you a different stat. Look at it a different way. The 2-year to 10-year spread. That's the one everyone talks about a lot, as when that inverts, that says it's really likely, and inverts meaning the 2-year providing a higher yield than the 10-year. That's when it's really likely that a recession's coming. Right now, the spread between the 2-year and the 10-year is 6 basis points, 0.06%. So we're right on that fine line. And what that tells you is that the market expects, and this is crazy to say this, the market expects that the Fed is going to have to cut rates at some point, because they're going to cut rates, which brings the 2-year down and makes that yield curve normal again. The 2-year to 10-year spread is usually 112 basis points on average.
Wow.
So for us to get anywhere near normalcy, obviously we're in a rate hike time frame right now, but in this economic environment that we're in, the market is telling us that the Fed is going to have to cut rates because they control the front end of the curve to get it back towards something that looks normal.
Yeah. So let's talk about that a little bit more, because again, the Fed told us on Wednesday afternoon, right, with their dot plot, that they will be cutting rates. They're talking 2024. I think what you're telling me is the market is saying, yeah, right, good luck.
Yeah.
It's going to cut before that.
Yeah. And we've been in this camp, Michael, you and I, to different degrees. Like I actually think and continue to think that the Fed isn't going to be able to raise rates quite as much as what you do before they break the economy.
Yeah.
And we'll see who winds up, being correct there. But a lot of the leading economic indicators right now, very different than lagging economic indicators, are already saying things are rolling over. And so so to be clear, like the one thing that the kind of pro-economy people saying that we're in a strong economy right now are saying is, look at the consumer, look at the consumer, look at unemployment. Well, the consumer and unemployment and wages are lagging economic indicators.
Yes.
Those are saying where we come from. People are reacting to the profits they've gotten before. Companies are reacting to the profits they've gotten before to pay their employees, hire more employees, et cetera. You look at other things like the stock market being a very good leading economic indicator. You look at things like building permits, that's starting to roll over. New housing starts, that's starting to roll over. All of these things that are more forward looking are starting to be like, I don't know. And you look at the commodity space, like oil, to kind of take that one out. But you look at lumber, we talked about this last week, absolute free fall. It's been cut by 60 to 70% since the beginning of the year. So 6 months ago, lumber was 70% higher, somewhere in that ballpark. Copper, involved in everything we build, from electronics to cars to buildings, et cetera, rolled over on us. So a lot of these things that are more forward looking are starting to say, watch out a little bit. We're going into a recession.
Yeah. And again, I've actually admitted the last week or so, I had a call that I thought a recession would be Q2, Q3 next year. I don't think that call is going to be right. I think it's going to happen this year. And frankly, there's a good chance that Q2 GDP goes negative, and we might be
in it right now. That's what you're saying. So I didn't actually put the video out yet, but we'll put it out here soon on Instagram. It talks about, are we in a recession right now? And we know, you and I and everybody knows, the fact that Q1 GDP came in negative.
Yeah.
And it was an absolute anomaly because of imports, exports, and there was some weird accounting stuff going on there. But all that said, it wasn't a bullish sign for the economy by any stretch of the imagination. And we talked about this pre-call, but the Atlanta Fed puts out what they call a GDP Now forecast. The GDP Now forecast tells you what they expect the July 28th or Q2 print to be. So we've already experienced one negative print. And if you had looked just 1 month ago, it expected GDP for Q2 to be 2.5%.
Yep.
Right now, when you look, 0.0. So that says they expect it to be 0. If it comes in beneath forecast, we're in a recession. If it comes in above, we're obviously not. But that's got to be a 50-50 breakdown right now.
Oh, yeah.
They're on the line of 0.
Yeah, I don't feel good about my call. I will not change it because I want to acknowledge when I'm wrong. But yeah, I don't feel good about that call.
Oh, wait, listen, I'm not. That's not the point of me peppering you on whether we're in a recession or not. This is just like, let's look at the facts. This is what the facts are. And the greatest thing about that GDP Fed, I'm sorry, Atlanta Fed report is it's not qualitative at all.
Oh no, it
is strictly quantitative. They just take the numbers and break them down. And that's what it's telling them right now.
And the reason it fell, because if you were looked at it a week ago, it would have been 0.9% was their last reading. Why did it change? They took qualitative metrics. New home construction was down 14.4%. They gobble that number up, throw it in there. Because again, it was expected to be down, but it was only expected to be down 2.3. Then it was down an actual 14.4. That one change takes it from 0.9% growth to 0. And I don't think we're going to get a good economic metric for months. So it's not good.
And we're not telling your audience anything here, but the spillover effect when it comes from the housing to the rest of the economy in general is just, it's massive. Again, I would be preaching to the choir talking to you guys about that.
So the last thing about fixed income market, again, is the canary in the coal mine. How loud is the canary screaming right now that we have problems ahead?
Yeah, it's telling us in a significant way. The other thing that you can look at, which is an earlier indicator. So as you come down in the quality of companies, they have to pay a bigger yield. A lower quality company has to pay you more to lend them money. Obviously, the risk there is more significant. And what's interesting is that usually the lower quality spreads is what they call it. Spreads blow out, meaning all of a sudden investors start to say, okay, this is a risky company. They are the earliest ones that we're going to require to pay more money if it looks like we're going into an economic downturn.
Okay.
And so in April, spreads on high yield bonds were at 3.4%. And when I talk about spreads, 3.4% over the treasury. So if the treasury's yielding 3%, you need to now pay 3.4% over that. So you're now paying 6.4%. It went from the 3.4% spread in April to 5.17 now.
Wow.
So you've seen almost 2% back out in high yield spreads. That's a really good economic indicator to say, take a step back, take a breath, and reassess what you have inside your portfolios, because that's a big movement in a very short period of time.
Yeah, this is amazing. Again, I consider the bond market or fixed income to be the smart money. They are squeaming, they are squawking. It is, I can't believe that the lowest year before was 2%. Now we're at 11. That'll wake you up.
Yeah. What's interesting is that in the past, obviously, and I'm getting a little off topic maybe, but still on bonds. In the past, usually you've seen an inverse relationship over time between stocks and bonds. The reason this year's been so darn tough is that they both moved down precipitously in the same year. So like the year that the bonds were down 2% in the last 20 was 2013. Stocks were up like 29% in 2013. So like, you're like, well, I lost a little money, my bonds, my stocks absolutely ripped. And then conversely, on the other side, when stocks are doing poorly, like 2008 was the worst year in the last 20, they were down 37%. Bonds were up 5.4% that year.
Yeah.
So like usually you get a yin and yang out of them. This year it's been a yin or a yang, whichever one, but it's not both of them.
Yeah, you get one or the other and it's not good. That's good.
Yeah.
Well, Taylor, where can people find you? Because you're putting out daily content that people need to check out.
Yeah, thanks. Follow us on Instagram at Life Goal Investments. So at Life Goal Investments on Instagram.
Thanks, buddy.